Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Netflix's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Netflix is a subscription-based streaming service. It allows members to watch TV shows and movies without commercials. With over 200 million subscribers, they are the largest paid video streaming service in the world. The company is headquartered in Los Gatos, California, and was founded in 1997. The ticker trades on the Nasdaq, Xetra, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Borsa Italiana, Vienna, Lima, Bulgaria, Kazakhstan, Sao Paulo, and Buenos Stock Exchange. Let's get started with the model. This is a large cap company, 89 billion market cap. They're trading at $200 a share, and they have 444 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2020, but negative in the other years. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was over $5 billion in 2021 and the trailing 12 months. Revenue is a sales for the company, and that's growing a lot from 20 billion to 30 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That was highest in the trailing 12 months at 12.7 billion. Below that is your operating expenses. Gross profit minus operating expenses gives you your operating income. And that was also highest in the trailing 12 months at 6.2 billion. They received 338 million of interest on their investments, and they paid 759 million of interest on their debt. That is a lot lower than 2020, a little lower than 2021. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is really high in 2021 and the trailing 12 months. This is the company's income statement from the latest 10Q. Here's the first quarter of 2021 and the first quarter of 2022. And their revenue in the first quarter was 7.9 billion. Pretty much all their revenue is the monthly fees from subscribers on their streaming service. But I was surprised they still have DVD revenues. That was 40 million. But that's probably going down each quarter. Eventually it's going to be zero. Cost of revenue is 4.3 billion. Marketing of 555 million. Technology and development of 657 million. General and administrative is 400 million. Their operating income is pretty flat this quarter compared to last year's first quarter. They spent a little less interest on their debt, and their net income was a little lower this quarter at 1.6 billion compared to 1.7 billion. So their earnings per share are 360, diluted earnings per share are 353. And they didn't add many shares. They had 443 million in 2021. Now they have 444 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So they are generating positive cash flow since 2020. But it was a lot higher in 2020 compared to now. They spent 560 million in CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they usually have negative free cash flow except in 2020. So they did add a lot of debt in 2019 and 2020 to fund their operations. And they do add some capital stock each year as well. They did pay down 600 million in 2021. This is the operating section on their statement of cash flows. And they generated 920 million of cash flow with a net profit of 1.6 billion. They have to buy a lot of content in order to get the rights to show movies and TV shows on their platform. They have to pay the person or company that owns that content. In the first quarter of 2022, they added 3.6 billion of content. They carry the content on their balance sheet and amortize it over their useful life. They passed through 3.2 billion of amortization expenses. This brought down their net income, but we add it back here on a statement of cash flows because amortization is a non-cash item. In the first quarter of last year, they passed through 2.7 billion of amortization. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And their revenue only goes up. But we all know in the first quarter of 2022, the company lost subscribers for the first time ever. Every single quarter, their subscriber count increased. except for the most recent quarter. So that's why there's a huge sell-off of the stock. This is their investing and financing sections on their statement of cash flows. In their investing section, they spent $121 million of PP&E, and they spent $125 million in acquisitions. In their financing section, they paid down $700 million of debt, and they added $14 million of common stock. This is the equity section on their 3/31 balance sheet. They have $17.5 billion of equity. They raised $4.2 billion from selling common stock, and they bought back over $800 million worth of their common stock. And they have positive retained earnings, positive $14.3 billion. Retained earnings is the sum of all the company's prior net incomes. Let's look at the capital structure. $17 billion of equity, $14 billion of debt. They're 55% equity, 45% debt. And their net debt is $8.5 billion. Net debt is debt minus cash. This is their capital structure since 2015. And usually they have a higher debt balance than equity balance. But just recently their equity balance has crossed above their debt balance. So that's a good sign. And they do keep lots of cash on their balance sheet at any given time. I gave them the whack on Simply Wall Street, 6.24%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $178 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $138 billion. We divide that by 444 million shares. And we get a calculated stock price of $310. They're trading at 200, so they're trading at a 35% discount. It's a buy according to the model. Their revenue projection for 2024 is $39 billion. For 2023, it's $35.8 billion. And for 2022, it's $32.4 billion. And then I just grew their revenue in 2025 at a similar rate. So that's how I got their future revenue estimates. It seems like 2022 may not be a good year, so I gave them negative free cash flow. And to calculate their future free cash flows after 2022, I looked at the average company in their industry, and the average company converts 15% of their revenue into free cash flow. So I multiplied their future revenue estimates by 15%. That's how I got their future free cash flows. The website Simply Wall Street is at 706. They're saying the stock is 70% undervalued. 38 analysts priced this stock, and the average price target is 302. The low is 235, the high is 405. This is where the stock has been trading the last 5 years. So if you bought the stock in the beginning of 2018, you would be flat right now. The stock was up to $700 at one point, but it's really come crashing down ever since that time. In the past 2 years, this stock is down 53%, Roku is down 25%, Disney is up 15%, and the S&P is up 48%. They have a beta of 1, so the stock moves with the market. It's gone down 58% in the past 52 weeks, while the S&P is up 3%. The 52-week low is 199, the high is 700. And the stock is trading well below its 50-day and 200-day moving average. In the past 10 trading days, nearly 30 million shares have been traded each day on this stock. Of the 444 million shares outstanding, 438 million are on float, 83% are held by institutions, and 1.75% of the shares are shorted. They've done 2 stock splits, a 2-for-1 in 2004 and a 7-for-1 in 2015. Their employee count has gone up a lot the past few years. They're currently at 11,300. If you invested $10,000 into this company 10 years ago, you should be happy with $176,000 today. But you're probably annoyed because just a few months ago, you were over $500,000. The annual salary for the CEO is $650,000 and the compensation package is $43 million. In the past 12 months, there's 2 insider sell orders and a buy. I'm sure TCMI is really happy they sold at these high prices. And the CEO bought at close to $400 a share, 51,000 shares. 82% of the company is held by institutions, 16% by the general public, and 1.3% by insiders. The biggest shareholder is Capital Research at 13%, then Vanguard, BlackRock, Fidelity, and T. Rowe Price. Let's look at their financial ratios. Their price multiples have gotten really good because their market cap has come down so much. Price to book of 5.1. We cannot look at the price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. A lot of it is content at $31 billion, $1.4 billion of property and equipment, and $4.7 billion of other. Let's look at their non-current liabilities. They owe $3 billion on content, They owe $14.5 billion on debt and $2.6 billion of other. They have a high return on invested capital of 19%. They can cover their interest payments with their operating income more than 8 times. A really high ROE of 29%. And their current ratio and quick ratio is slightly above 1. Let's look at their current assets, $6 billion of cash and $2.1 billion of other. Let's look at their current liabilities. They have $4.1 billion of current content. This is content that will be amortized in the next 12 months. They owe $617 million to their vendors, $1.8 billion of accrued expenses. These are expenses the company has incurred but it has not paid it yet. $1.2 billion of deferred revenue. This is when people prepay for their monthly subscriptions. In the trailing 12 months, they had negative $27 million of free cash flow, and they have positive $358 million of working capital. So it looks like they should have enough funding to get through the next 12 months without adding any debt. The best way to look at ratios is to compare them to companies in the same industry. There are 39 companies in the same industry as Netflix. And if Netflix has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend less than average in CapEx. They have a better debt to equity ratio than average. They do not pay a dividend. They have negative free cash flow, so that's a lot worse than average. They're the third largest company on this list. Their price to book and PE are better than average. We can't look at their price to free cash flow. Their price to sales is better than average. Of course, they generate more revenue than the average company since they're so big. And their revenue is growing faster than average at 22%. Average is 6%. But in this most recent quarter, their revenue grew less than 10%, which is a big problem for this company because their quarter-over-quarter revenue growth was 15 to 20% the past several quarters. And they have a good ROA and ROE. ROA is net income over assets. ROE is net income over equity. So to summarize, I have them trading at a 35% discount. But it's like trying to catch a falling knife. And a lot of people don't like investing that way. But they are the biggest streaming service in the world, so it's really hard to believe that the stock will keep falling. But I guess crazier things have happened. I ranked their free cash flow as 3 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.